All right, next we're going to dive into the accounting cycle. So the accounting cycle is very important. Every company in the world does the accounting cycle every single year. So it's a 9-step process. So essentially, let's just say hypothetically, me and you were business partners. We make water bottles and we sell it for a profit. Very simple business. So let's just say throughout the year, we know what's going on in our business, but now let's just say we need a loan from the bank to buy, let's say, a piece of equipment now. The bank's going to require financial statements from us. So what we're going to do is we're going to pretty much keep all of our source documents, such as our receipts, our invoices throughout the entire year in a shoebox. Then we're going to take the shoebox over to our accountant now. Now our accountant is going to perform the accounting cycle on our books. So essentially we can arrive at the financial statements and close the books at the end of the year. So the first thing the accountant is going to do is he's going to analyze the transaction. So let's just say he picks out a random receipt from the shoebox. It's a gas receipt. He's like, okay, these guys probably have a delivery van, so they need gas. So you know what? That's going to give rise to a gas expense and cash. So step number one is analyzing the transaction. Now, step number two is journalizing the transaction. The journal has to be done in a very specific way. So we have date, accounts, debits, and credits. And when it comes to the journal entry, the year always goes first and then the date. So 2023, November 15th. And then debits always go first and credits always go second. So let's just say we poured gas for $50. So we're going to debit gas expense because remember, expense is increasing. Expense is a debit account. So we're going to debit it. And then let's say hypothetically, we pay $20 cash and we still owe $30 to the gas station, correct? So we're going to credit cash because now credit is an asset and our asset is decreasing. So we're going to credit it. And now we're going to credit accounts payable because accounts payable is a liability. Our liability is increasing. So we're going to credit it. And as you can see with this journal entry, debits must always equal credits. So hypothetically, if you did just this transaction would be incorrect because it doesn't balance. So the number one rule of thumb in accounting is debits must always equal credits. Very important. So let's just say we have a list of transactions. We're going to analyze the transaction, journalize the transaction. And then what we're going to do next is we're going to do the general ledger. In other words, the T accounts. So general ledger is a much more complicated way to do the T accounts. I'm going to skip that altogether because T accounts is much more easier. And the benefits of the T account is it keeps track of every transaction that goes on in our journal. So we're updating the balances in each account as we go. So for instance, what we're going to do now is we're going to locate the gas expense T account over here. And it's going to be $50, which we're going to debit. Remember, left side always debit, right side always credit. Debit, credit, debit, credit. And as you can see, these accounts have account numbers. So cash is 101, accounts payable is 205, gas expense is 550. Remember, assets are in the hundreds, liabilities are in the 200s, equity, shareholders' equities are in the 300s, revenues are in the 400s, and expenses are in the 500s. Depending on your course or what you're trying to learn, this might not be relevant, the account number, so you can ignore that altogether. If you haven't heard about it before, just ignore it. Then we're going to locate the cash T account and we're going to credit it for $20. So just to kind of rewind, gas expense, we're going to debit it for $50. Then gas expense, we're going to credit it for $20. And then we're going to locate the accounts payable T account and we're going to credit that for $30. So right now I'm just briefly introducing the accounting cycle, but in future videos, I'm going to dive into this in much more detail and kind of tackle each step in much more detail. So once we're done with the T accounts, then we're going to prepare the adjusted trial balance. All the adjusted trial balance is first of all, it's not a form of financial statements because we got 4 financial statements. We have the income statement, the statement of changes in equity or the statement of retained earnings, the balance sheet, and the statement of cash flows. The trial balance is not a form of financial statements, but it's very important in the preparation of doing the financial statements. So it essentially takes all the accounts we have in our T accounts, and it takes the ending balances, and it sees if the ending balances at the end of the period equal to each other. So the next step we're going to do is we're going to go to our T accounts and we're going to calculate the ending balances in each T account. So essentially, since cash is an asset and asset is a debit account, we're going to add up all the debits, subtract all the credits to get the debit balance. To get the 1400, I did 1000 plus 450 minus 30 minus 20 to get 1400. Now accounts payable is a liability, which is a credit account, so it's going to have a credit balance. So we're going to add up the credits, subtract the debits to get the credit balance. So we're going to do 500 plus 30 minus 100 to arrive at 430. Now gas expense is set to be a debit account because it's an expense. So we're going to add up all the debits. Since there's no credits, we're not going to subtract anything. So we're going to do 55 plus 65 plus 50 to arrive at 170. Now the trial balance is going to have a three-part title: the company name, trial balance unadjusted, then the date at December 31st, 2023. Then we're going to have accounts, debits, and credits. So now we're going to list the accounts under the trial balance in the order of assets, liabilities, shareholders' equity, revenues, and expenses. I'll explain to you why in a bit. So for instance, the first one we're going to do is cash, and the cash balance is going to be 1400 debit. Then let's just say we have accounts receivable here, that's XXX, making up a number. Land is XXX. Now we're done with all of our assets. Now we're going to shift our attention over to our liabilities. So we have accounts payable, which is 430. Credit. Let's just say we have salaries payable, XXX. Now our liabilities are done with. Now we're going over to shareholders' equity. We have common shares, XXX. Retained earnings, XXX. Then we have sales revenues, which is revenues. We're done with our shareholders' equity, XXX. Now we're going over to our expenses. So we have depreciation expense, XXX. We have gas expense, which is 170. And then we have rent expense. So now we're done with all of our accounts. Let's say hypothetically all these accounts were here in our T accounts. So we're just pulling the account names and the ending balances. That's it. Then we're going to add up all of our debits, which equals 12,300. Add up all of our credits, which equals 12,300. Since this balances, we're on the right track. Now, the importance of doing the trial balance in the order of assets, liabilities, equity, revenue, and expenses is because if you look at this over here is the income statement, which comprises of revenue minus expenses. Then this over here is a statement of change in equity or statement of retained earnings, which deals with the changes in common shares and retained earnings. And then this over here is the balance sheet, which is assets equals liabilities plus shareholders' equity. So we're already kind of doing the financial statements within the trial balance, which is why this is very important. So that's step number 4. Now, step number 5 is the adjusting entries. So adjusting entries are going to be done at the end of the year. So just picture a list of transactions. So with those transactions, once again, we're going to analyze those transactions. We're going to journalize those transactions. Then we're going to update the same T accounts. Once we're done that for the list of transactions, we're going to calculate the new balances in our T accounts. And then we're going to prepare the adjusted trial balance the exact same way we did the unadjusted trial balance. But it's just going to include the new accounts, the updated accounts, and the updated balances. That's it. Then, based off the adjusted trial balance, we're going to prepare the 4 financial statements. Once again, income statement, statement of changes in equity or retained earnings, the balance sheet, and a statement of cash flows. Then step number 8 is the closing entries. Once again, for closing entries, we're going to have a list of transactions. We're going to once again analyze those transactions, journalize those transactions, and update the same T accounts. Once we're done that with the closing entries, then we're going to prepare the post-closing trial balance. So in this video, I'm just briefly introducing the counting cycle, but in future videos, I'm going to dive into each step in much more detail and do actual real questions.